Hello, you're welcome to Campus Zealand Media, and we are going to handle part 2 of the partnership accounts today, where we shall be looking at how we account for goodwill. If in case the partnership business is handling goodwill, how do we put it in the books of accounts? Then we are going to also look at how we revalue assets in case assets are going to be revalued in the books of accounts. What's a double entry for revaluation of assets in the books of accounts? Thank you very much. Thanks for watching. You can subscribe for more videos that will be coming in.
Hello everyone, good morning. So welcome back to Campus Zealand Media. Today we are, as you've heard in the introduction, we are going to be looking at goodwill, how we are supposed to be treating goodwill in the books of accounts. And basically we are going to start with the types of goodwill, that is purchased goodwill, whereby you are looking at the purchase consideration exceeding the fair market value of the assets you have in your business. For instance, if somebody is to contribute goodwill, maybe they want to contribute, the contribution they want to make on goodwill contribution is maybe 60 million. That means that's their purchase consideration, what they want to bring, purchase consideration. But the fair market value, if you value our assets, fair market value is maybe 50 million. So you are seeing that the purchase consideration which somebody wants to contribute is exceeding goodwill. So the extra is what we call goodwill. The balance between the two figures, the 10 million is the goodwill that is being paid for. So purchase goodwill, the purchase consideration is exceeding the fair market value of our assets. Then negative goodwill will be the opposite, whereby the purchase consideration is lower. Maybe somebody wants to contribute 40 million. That's the amount of money he wants to buy our assets. But then the fair market value of our assets are 50 million, so it is lower. Then you have negative goodwill. The second scenario. Then the third scenario, inherent goodwill, where that one just arises out of carrying out daily activities of the business and it isn't recorded in the books of accounts. So now we are going to look at, we've seen the types, now we are going to look at methods for accounting for goodwill, how they account for goodwill. We have three methods of treating goodwill. One, you can use the revaluation method. Revaluation, here we say that we recognize goodwill and maintain it in the books of accounts. In other words, since goodwill, this method of revaluation, goodwill is an asset. Revaluation method. So goodwill is an asset, and if it is coming to the business, we shall debit that asset increasing. Debit goodwill account. Then we credit the partner's capital account. Partner's capital account. And here we shall be using the old profit sharing ratios to debit and credit. We shall be sharing that goodwill using the old profit sharing ratio of partners. Then in this method we say revaluation, what is key is that you recognize goodwill and you maintain it in the books of accounts. Then when you go to memorandum revaluation method, it shouldn't confuse you. They just, as long as the word is memorandum, even if they include in the revaluation method, they are talking about memorandum revaluation method. So there, for memorandum revaluation, we are supposed to be, one, recognizing goodwill, then writing it off. Goodwill is recognized in the books of account, then it is written off. In other words, you recognize goodwill by debiting that asset, debit goodwill because it is an asset increasing in our business account. Then you credit the partner's capital account because it is the partner's capital account. The partners are their capital accounts are going to be increasing because they are going to be sharing goodwill. And you know that if the partners' capital accounts are increasing, we have to credit them. But we shall still be using the old profit sharing ratios here when you are passing this entry. So under this method, we have said that we recognize goodwill, then later we write it off. So when you're writing it off, you reverse this entry. In other words, you're supposed to be on writing off. This is on recognition, the first entry, then on writing off goodwill. On writing off goodwill. So writing off, you pass the opposite. So you reverse the entry. First of all, you have to recognize goodwill reducing because you're writing it off from the books of accounts. So you credit an asset reducing goodwill account. Then you debit the partner's capital account because they are also going to reduce. You are removing it from the business. So partner's capital accounts are reducing. We debit capital reducing partner's capital accounts. But in this case, you have to take note that we use the new profit sharing ratios here. When we are recognizing, we use the old profit sharing ratio. We are recognizing goodwill coming in, the first entry on recognition. But on writing off, you have to be debiting and credit, but use the new profit sharing ratios of the partners. Then the third method, you are going to see that we are going to be looking at, of course, we've seen the revaluation whereby you just recognize and maintain the books of account. Memorandum, you recognize goodwill and then you write it off. Then the third method, premium method. Premium method, you are going to see that what you are now. This one brings out the issue of purchased goodwill, whereby somebody pays in excess, somebody contributes capital, but is supposed to, maybe somebody is supposed to contribute when he's coming to the business, supposed to contribute capital worth 50 million, but he pays maybe 55 million. This is the capital supposed to contribute, but he pays additional 5 million. Now that 5 million is the goodwill or the premium, what we call the premium. Is contributing towards the efforts of the old partners, because he's going to come into the business when maybe the business is already established, it has its own market, it has experienced workers, so he has to contribute towards the efforts. So this premium, the extra 5 million, there are 3 ways of treating it in the premium method. One, the partners can, the first method, the partners can decide not to write it in the books of accounts. In other words, they just share it and they don't make any mention about it in the books of accounts. So they don't mention it in the books of accounts. In the books of accounts. Then the second method, you are going to see that the partners can decide to increase their capital accounts. In other words, they are going to be, since somebody is going to be contributing that extra 5 million, they will be debiting the cash account, bank account, to show that capital is increasing, and they will be using it to increase their capital accounts. So they just introduce it, they just use it to increase their capital accounts. So you credit partners capital accounts, partners capital accounts. So this second method is whereby the partners are going to use that premium to, because we have said there are 3 methods of treating that premium. One, you just share it and don't mention it in the books of accounts. Secondly, you can use it to increase your capital balances, you as partners. So you debit cash coming in, you recognize that you are increasing your capital accounts. Then third method, you receive it, you receive it into the books of accounts, you recognize it. In other words, you pass this same entry, debit, credit, cash, stock, bank account. Then you credit your partner's capital account, partner's capital account. Then you later, the third method, you recognize it, then you later remove it from the books of accounts. In other words, you debit partners capital accounts, then you credit your cash or bank, stock, bank account. So we've said, like we've been saying, we are treating goodwill. So we are going to have a clear example. The other what we have just seen, we've been looking at how they pass the journal entries, the methods, the types and circumstances. So here you are going to be having a clear example. We are going to be working out an example where we see how we are supposed to be treating goodwill, and using the various methods we've seen. That is the revaluation method, where we recognize goodwill and maintain it in the books of accounts. Then we shall be looking at still the memorandum revaluation method, whereby you recognize goodwill and then you write it off. Then we shall see how our balance sheet will look like. So we are going to, like this question you are seeing, they are giving you XYZ limited partners sharing profits and losses equally. So we are going to see how we are supposed to be, first of all, using the revaluation methods to account for goodwill, then memorandum revaluation method, then maybe the capital accounts. Yeah, basically that. So we are going to work out that example we just shared. So we are saying XY limited are partners sharing profits and losses equally, meaning that they are sharing profits and losses equally. The old profit sharing ratios are 1-to-1, because they have said they are sharing profits and losses equally. So 1-to-1 or 2-to-2, any, or 1,000 to 1,000, but basically it is a simple ratio, 1-to-1. Then they are saying that they decided to admit a new partner Z. By agreement, goodwill was valued at. So goodwill was valued at 6,000. Goodwill was valued at 6,000 to be introduced in the books of the partnership. Z is required to provide capital equal to that of Y after he has been credited with his share of goodwill. The new profit sharing ratios for X, Y, and Z are, so new profit sharing ratios, new profit sharing ratios are 4-to-3-to-3. 4-to-3-to-3. Then and the question is requesting us to, first of all, open up ledger accounts to reflect the admission of partner Z and treatment of goodwill using a revaluation method. So we are supposed to start with the revaluation method. Revaluation method, we said we recognize goodwill and we maintain it in the books of accounts. revaluation method, where we recognize goodwill and maintain it in the books of accounts. So recognize goodwill. So it means since we are using revaluation, we are supposed to, on recognition of goodwill, debit goodwill, then credit the partner's capital accounts, but using the old profit sharing ratios, So it means you have to have a tier account for goodwill and a tier account for partnership, for the partner's capital account, because they are saying that you prepare the necessary tier account. So there must be a goodwill account here. Let me draw it here. Goodwill account. Then I must be having the partner's capital account somewhere, because I have to pass those entries. So we have in partners. So when you're answering these questions, you have to read you have to read the entire question and see all the partners that are in the business. You are supposed to be making an account of them. So details. So like we are saying, we are using the part A was asking for treatment of goodwill using one revaluation method, where we recognize goodwill and we maintain it. So we debit goodwill and we credit partners capital account using old profit sharing ratios. So this is the goodwill account. This is the partners capital account. So I'm supposed to be passing the debit in the goodwill account. In other words, but using the old profit sharing ratios. So debit goodwill using the partners capital account. So we have how many partners? But since we are using old profit sharing ratios, we must only recognize the old partners. X and Y were the old partners. So we are supposed to be sharing goodwill using their old profit sharing ratios. And we saw in the question it is 1 to 1. So you get of course for partner X it is going to be 1 out of the total ratio times the goodwill, which is here 1 out of the total ratio times goodwill. So this is 3,000. Same applies to this one because they are sharing profits and losses equally. So it means I'm supposed to be debiting goodwill using the old profit sharing ratios, and those are the ratios I've gotten at. So this is my goodwill 3,000, even this side 3,000. So we have debited goodwill. Now we have passed the debit into. Now we are supposed to pass the credit. We are supposed to pass the credit into, which is credit the partner's capital account. So the debit is here. The credit must go on the credit side of the partner's capital account. So I must put goodwill here. Goodwill. Then I show that partner X contributed, shared 3,000 of the goodwill, all got 3,000. Then partner Y got also 3,000. Then after, I recognize that they told me in the question that there is some partner who has admitted by agreement of goodwill value that some partner Z. That's why when you are drawing the partner's capital account, you have to include you read the question until the end, then you include all the partners in your capital account. So initially this wasn't an old partner, that's why he's not getting a share of goodwill. So we are supposed to recognize that this partner was required to contribute. When you look at the question, Z is required to provide capital equal to that of Y after Y has been created with share of goodwill. So it means that here, after Y has been created with share of goodwill, but take note that in the question they gave you opening balances of the capital accounts, which I had forgotten to record. So it means you have, when you are maintaining the capital account, you start with the opening balances, which you had forgotten. So you can first of all write the opening balances, because you have a balance sheet which is showing the opening balances of partners capital account. So balance brought down. If you check the question, X is 8,000, then Y is 4,000. I've forgotten that detail. Then now we can share our goodwill, because an account must have some opening balance, maybe if it is given in the question. Then we can now pass the other entry we had passed of goodwill here. Goodwill, which is 3,000 each. Now they say that Z is just a new partner who is supposed to contribute capital equal to that of Y. He's supposed to contribute capital. This guy is supposed to contribute capital equal to that of Y. This amount of money after this Y has been created with the share of goodwill. So this is the share of goodwill of Y. You have created it here. So it means the total amount of money Z is supposed to contribute is the sum of these two. His capital plus after creating him with the share of goodwill. So it means this one is supposed to be paying to us 7K in relation to goodwill, and he will be paying it into our business bank account. So in other words, when a partner comes into the business, we are supposed to recognize that we debit our bank because it's going to give us money, and we credit his capital account because his capital is going to be increasing. So we have credited the capital account using bank. Now we are supposed to open up a bank account and recognize that capital. So I draw a bank account here, bank account. So when you check the trial balance, I think bank had some opening balance of 2,000. So the balance brought down for bank is 2,000. Now this guy contributed money to the business worth 7,000. So this is the credit, the debit must be going to the bank, showing that bank is increasing. So I show that partner Z, you can put capital in brackets partner Z capital, which is 7,000. This is partner Z, 7,000. So we can now get a new closing balance for bank, which is 9,000. This one 9,000. We need to try to balance. So the carry down is 9,000. So now this is my new balance at the bank. It means it is what I'm supposed to take my statement of financial position. So we can also balance off the goodwill account here. Balance off the goodwill. This is 6,000. When you balance 6,000, so your carry down still is going to be 6,000. Then we can balance off the capital accounts of partners. Got in this. We can balance them off. This is 7,000. 7,000. This is 11,000. So 11,000, 7,000, and 7,000. So you are seeing that our closing balances are 11,000, 7,000, and 7,000. So now it means that you can use this data because they asked you to prepare one. Using revaluation, you're supposed to show how goodwill will be accounted for. So we've seen to account for goodwill, you have to prepare a goodwill account because you pass this entry, goodwill account and partners capital account. Then they asked for the balance sheet for both parts. Part A, which was revaluation. So you must do a balance sheet first of all to reflect the closing balances, these capital balances, and then also this goodwill, it was maintained. So it is a new asset in the business, we must reflect it. Even this bank balance, bank has a new balance which must also reflect. So I'm going to prepare that simple balance sheet. They gave us a simple balance sheet which was showing that net assets, let me draw it here, the balance sheet. It was showing that our net asset, our non-current assets are 15,000. So in the balance sheet, I'm going to put it here, balance sheet, non-current assets are 15,000. Then you're having a new asset, goodwill, because here we recognize goodwill and maintain it. A new asset, goodwill worth 6,000. So I recognize goodwill as an asset, which is 6,000 still. Then I recognize what else? Bank is also an asset, and we have gotten a new balance for banks. So what we are supposed to record, new closing balance, bank, which is 9,000 in this case. So now we've seen that we have non-current asset. The figure was given in the simple balance sheet, which we have recorded 15,000. Then we have another asset, goodwill, coming in, which is 6,000. Then we have bank. We have a new balance for bank since some partner contributed capital. So we have a new closing balance for bank. I recognize it here. When you sum up, you're going to see that you're going to get a total of 30,000. Then you can also now go, if you take a simple balance sheet, you can have the capital, because you know that assets are equal to liabilities plus capital. Under capital, you are going to be having partners X, Y, and now the new partner Z. So X, the closing balance for partner X is 11,000 of the capital account. So I recognize that 11,000. Then for partner Y, it is 7,000. I recognize it there. For partner Z, it is 7,000. Still, I recognize it there. Then, of course, that is capital. Then we can look at any liabilities in case they are there. We have current liabilities worth 5K. So I can also recognize the current liabilities. They are worth 5K. So when we sum up this, you're going to be getting 11, 14 plus 5. So that is 30,000 still. So you are seeing that your balance sheet is in balance because the assets are equal to the capital and liabilities. So part B, they were asking for memorandum revaluation method. So we are going to now account for goodwill using the memorandum revaluation method. And in the memorandum, we said we're supposed to first of all recognize goodwill, that is debit goodwill coming in, and asset coming in. Then we credit partners capital account because now they are going to be sharing that goodwill. But then that is on recognition. Then we write it off in the books of accounts. So you're supposed to be now showing that capital reduces and then goodwill also reduces and asset reduces. So I'm supposed to pass those entries. In other words, I have to be having a goodwill account which I've drawn here, then the capital account of partners which is here, including all the partners. So I start. You check. You are supposed to first of all pass this entry: debit goodwill, credit. So we are going to be debiting goodwill. Then we credit the capital, but using the old profit sharing ratios. So like what we did in the first method, the old profit sharing ratios are 1 to 1. So it is a half times 6,000 for both of them, because 1 out of the total ratio times the goodwill. So for X and for Y, so you'll be getting 3,000 for each. The ratios in which they share goodwill. So I pass this debit entry, which is X and Y. I show that this is 3,000, 3,000. Then you have to pass the credit on the capital account. But capital account, when you check the balance sheet, it came with some balances. It has some opening balances, which are these ones. Then you now pass the credit into this is the debit. The credit has to go to the capital, which is goodwill shared. Goodwill, which is this one 3,000. Then this one is also 3,000. Then I recognize that some partner contributed capital. No, I can first of all write off goodwill, because in the memorandum we recognize goodwill and I've recognized it debiting goodwill and crediting capital. Now we are supposed to write off capital, but now using the new profit sharing ratios, and the new profit sharing ratios are 4 to 3 to 3, meaning that this is for X, this is for Y, and this is for Z. So it means X will be getting 4 out of the sum. This is 10. 4 out of 10 times the goodwill, the value of goodwill. Then Y will be getting 3 out of 10 times the value of goodwill. Then Z will also be getting 3 out of 10 times the value of goodwill, which is 6,000. I think that. So this is 2,400 if you multiply, and this is 1,800. This is 1,800 still. So it means these are the new profit sharing ratios. I'm now trying to write off goodwill, but using the new profit sharing ratios. So it means that when you're writing off, you credit goodwill. I'm supposed to be crediting this side, but since we are using the new profit sharing ratios, all the partners must be involved in when you're writing off. So X, Y, and Z. It means that X is supposed to be sharing 2,400 of the goodwill, so I recognize 2,400. Then Y is supposed to be sharing 1,800 of the goodwill, and then Z 1,800, like you've seen. So I've passed the credit on goodwill. The debit must be on the capital account of partners. So I'm supposed to be debiting the capital accounts of partners. So goodwill written off. Goodwill written off. X. Now I'm passing the debit entry into our second transaction. So X was sharing 2,400 on writing off goodwill. Then this one was 1,800, and this one was 1,800. So if we finish this accounting for goodwill, now we recognize that there is some partner who contributed capital, who came into the business, partner Z, and when he came into the business, he contributed capital equal to that of Y. Now this partner Y's capital, but after Y has been created with share of goodwill, so he contributed the total of this plus this. So he contributed 7,000. We recognize that if he contributes debit bank because he's giving money to the business, then we credit the capital account because this capital is increasing. So detail has to be bank here because it is the opposite entry when you are passing that entry. So it means you have to have a bank account somewhere to recognize the changes in the bank account. So I'm going to be having my bank account here, bank. If you check the question, it had some opening balance brought down of 2,000. Now since this one is giving us money, it's contributing capital, I have to recognize that capital of Z, capital in brackets Z, of 9K. I mean of 7K. Now I can get a new closing balance for bank. This is 9K and this is 9K. So my carried down closing balance carried down is 9,000. So it means now I can now balance off the accounts. Bank is already balanced. Now I try to balance off this account and I see. So this is 6,000. When you balance off this is still 8 plus that 0, 2. Even this one is 6,000. So the mere fact that in the memorandum we recognize goodwill and write it off, it means that here you're not going to have any closing balance when you balance off the goodwill account. You won't have any closing balance. That's why you're seeing that we don't have any closing balance. So it shouldn't appear in your current assets in your balance sheet at the end of the day. Then you can balance off this capital account of partners. So this is 7,000. This is 7,000 still, and this is 11,000. Then this is 7,000, 7,000, and 11,000. So I can now get the closing balance carried down. So getting the closing balance, 7,000 minus. So this is 5,200. This is 5,200. This is 8,600. So now they also start for the same with the financial position, a simple balance sheet. Of course, when you look at now, I'm going to clear that simple balance sheet, but under the memorandum method. So balance sheet, You check, they gave us the non-current asset figure, non-current assets figure. They gave us 15,000. I recognize it there. Then you have another asset bank, but you take note that bank has undergone some changes. We have a new closing balance for bank, this one. So what I record in my balance sheet. So bank is 9,000. Then you are checking that you are not in the other method we recognize goodwill because it was an asset remaining because of the revaluation method. But in memorandum revaluation, goodwill is written off, so you can't have any closing balance, so it doesn't appear in your balance sheet. So it means they are the only assets we are having. I can balance off and know the figure. So 15 plus 9, of course, that is 24,000. 24,000. Then you can go now to your capital because assets are equal to liabilities plus capital. So I can go to my capital. Capital for both all the partners X, Y, and Z. So partner X, it is now these are the closing balance we are supposed to take for in relation to capital. So partner X is 8,600. I recognize it here. Partner Y, it is 5,200, and partner Z, it is 5,200 still. Then I check, do I have any liabilities? Then I check, yeah, I have some current liabilities. I still recognize them. It is 5,000. When you sum up all these, you are going to come up with 24,000. So which shows you that your total assets are equal to liabilities and capital. So that's the memorandum revaluation method. So now we are now in this part we are going to be looking at revaluation of assets and liabilities. Revaluation of assets and liabilities. So revaluation, you are going to see that initially you are going to see that according to the historical cost concept, you are supposed to be recognizing assets in your books of accounts based on the historical cost. So you recognize the historical cost, the cost at which you bought it, not its current market value. But sometimes in businesses, you can have assets being revalued. In other words, you can have maybe you bought a car at 50 million, but now in the present period, you can decide to revalue and you want to ascertain the new market value of that car. So you can have, when you revalue based on the historical cost and maybe the new figure, if you revalue and you get a new figure, you have to ascertain whether there was an increase in revaluation or a decrease in revaluation. So you are going to see the accounting entries, for instance, because the basic accounting entries, you look at one, increase in the value of an asset. How do you treat it? Increase in the value of an asset. Then you'll be looking at the second one, decrease in the value of an asset. Value of an asset. Then you shall still be looking at increase in the value of a liability. The value of a liability. Then you can look at decrease in the value of a liability. The value of a liability. Then you are going to look at now, because after revaluing, you have to tell us whether there was a profit on revaluation or a loss. So we look at how we treat a profit on revaluation, and we also look at how we treat if it is in case of a loss on revaluation. Loss on revaluation. So basically, we are going to look at those, how we pass the journal entries. Because like I told you, you could have bought a car at a given figure, and now you are revaluing it to get a new market value. It can be a figure which is higher than the historical cost figure. Are you seeing that? So it means there was maybe an increase in the value. So we have to pass the double entry. We have to debit and credit. So when you are debiting, of course, increase in the value of an asset. Assets increase by debiting. I have to debit the individual assets. Debit the individual asset. Then I credit the revaluation account. Revaluation. So you just look at the impact of if it is an increase on an asset, we are supposed to be debiting. The opposite entry is revaluation because you are under revaluation. Then decrease in the value of an asset reduces by crediting. So you credit the individual asset. Then we debit the revaluation account. But you should take note that when we are debiting and crediting, here we have to debit and credit with the increase. But here we are supposed to debit and credit with the decrease. So use the decrease or the increase. But now we go to the side of liability. If we revalue the liability and there is an increase in the value of the liability, of course liability is increased by crediting. So you debit that individual liability account, individual liability account. account because its liability are increasing. Then you debit the revaluation account. Revaluation account. Then if it is a decrease in the value of the liability is reduced by debiting. So it means we shall be debiting that individual liability account, individual liability account. Then we credit liability account. Then we credit the revaluation account. So still we are looking at the journal entries. Increase in the value of the liability, you are supposed to pass this entry, credit the liability, increasing, then you debit revaluation, but still with the increase. You take note with the increase. Then here, if it is a decrease in the value of the liability, you debit that liability reducing, then you credit the revaluation, but with a decrease, figure, the figure. Then when you go to, of course, you are going to be having, you are seeing that revaluation is common everywhere. We shall be having a revaluation account, T account, big T account, called revaluation. Revaluation. So at the end of the day, we are going to have passed the credit entries and the debit entries, but we have to ascertain whether there is a profit on revaluation or a loss. So we are going to say we're supposed to treat that debit, credit. Of course, if it is a profit, remember this, if it is a profit or loss, those things have to be shared by what? By partners, because we are in partnership businesses. Now we are ascertaining if it is a profit or loss. It means that if it is a profit, partners accounts have to be increasing. It means you are supposed to be crediting the partners account, showing that the accounts are increasing. So it means if it is a profit, this must be, partners accounts must be credited because they will be sharing that profit. So you credit the partners capital accounts, because the only way of creating partners capital account means that they must be sharing profits. So it means that the balancing figure we shall be getting must be on the debit side of revaluation. So it means valuation. So it means maybe I'll be getting the balancing figure, the balance carried down must be this side. So that when I take it to the partners capital account, it lies on the credit side. Now when you go to a loss on evaluation, of course if partners are sharing losses, capital reducing. Means if they are sharing losses, they are contributing towards those losses. So their capital accounts must reduce. And capital accounts reducing, capital reduces by debiting. So partners account will be debited. Partners capital accounts. Then we shall be crediting. Of course, now it means now the credit side, that the balancing figure must be on the credit side of revaluation. In other words, you balance out the revaluation account and shall get a closing balance on this side. Meaning that when partners are sharing this, of course it can't be on the credit, and when it's going to the partners account, it also appears on the credit. It must be going on the debit. And the debit, the implication of a debit on the partners capital account implies reduction in that capital account. But a credit, like we say, a profit, implies an increase. So those are the double entries we pass. So we are basically going to do a number relating to this revaluation, and we are going to just basically following the double entries, and we are supposed to work it out. So we are going to now do a question, an example on what we have basically seen. We've seen goodwill and the method. So we are going to now see an example which is combining, first of all, goodwill, then revaluation, what we have just looked at, double entries. Basically, if you understand the double entries, now the T accounts, passing them in the T accounts is going to be very simple, because exactly what happens in the journal entries or double entries is exactly what we post in the T accounts. Then we are going to do this question which we are displaying, and we see how we are going to prepare these accounts. They are telling us to prepare the revaluation account, the capital account, the goodwill account, any other ledger accounts to reflect the above transactions, then the balance sheet for the partners. So basically we are going to be looking at that example. I hope you take note of it, so that when we are doing it, you can maybe basically you can have something to note down as you are following the question. So the question we just shared, we are going to start. They are requesting us to prepare the revaluation account. That's why I'm doing a T account for revaluation. Now you have to know the contents of the revaluation. You've seen the double entries. We've been passing the double entries. As we said, revaluation, we look at increase in assets, how we treat increase in assets, how we treat decreases in assets, if there's a value, how we treat increase in liability or decrease in liability. So basically those are the contents. So the contents of the revaluation, I have to look out in the question and I check for those assets that were revalued. For instance, you are seeing that if you check after reading the question, there is some note saying the assets were valued as follows, or revalued as follows. A, plant and machinery. It means I must be having a T account for plant and machinery. I only prepare T accounts for only those assets that were revalued, plant and machinery. So you only prepare T accounts for only those assets that were revalued. So you check the opening balance of plant and machinery. Where is it? In the balance sheet, of course, they gave it to you. It is 200,000. So I put my down. My balance brought down. It is 200,000. So now you have to have, since they are revalued, they have a new closing balance. That revalued figure is going to act as one new closing balance. I check the plant and machinery. The closing balance is 220,000. So you check. So since the original figure was 200,000, now when they revalued it, it is 220. Meaning there was some increase because this was originally. Now this is the current value. So there was some increase. I seen that. And in the increase we said with debit, we are supposed to be debiting an individual asset increasing. Debit individual asset. Then you credit the revaluation account. With the increase, it means that of course when you balance off, it comes automatically that this side you're going to use 220 to balance and 220 to balance. Of course now the increase you are supposed to recognize this side increase in revaluation. The increase is 20,000. So you are seeing that the increase is on the debit side, like what is in the double entry debit side of the asset account, which is this one. Is the one you're supposed to be debiting and crediting. So of course the debit is already there. Now I have to pass the credit on the revaluation account here, but the debit must be the asset itself, plant and machinery. The increase, which is 20,000, we've seen. I think that one is clear. Then you can look out for another asset which was revalued, equipment. So I do a T account for equipment. So when you check our information, another asset that was revalued is equipment. So I said we only prepare T accounts for only those assets that were valued or revalued again. So this is the second asset that was revalued. So you check the opening balance. Of course, is an asset having an opening balance from this side. The brought down is 300,000, and they carried down. Now our closing balance becomes the new revalued figure, which in the question was given to us as 350. 350, if I'm not mistaken, 350. Now you can balance, so to know that there was an increase or decrease. Of course, this is the bigger side, 350. 350. So you are seeing that it was an increase. Of course, the original value was this one, now the new value is this one. So it means there was an increase in revaluation, which I pass as 50,000. So we pass the double entry. We debit. Of course, the debit is already an asset increases by debit. That's why you're getting the figure on the debit. Then the corresponding credit entry must be going to the revaluation, the increase itself. So for that is equipment, which is 50,000. Then I go out. I look for another asset which was revalued. I'm seeing motor vehicles. So I must be having a motor vehicle account, having an opening balance. In the question they told me opening balance for motor vehicle it is 250,000, and the closing balance, if I check for motor vehicle, the carried down is 200,000. 200,000. Of course, now you can recognize that in the motor vehicle account we started the historical cost is 250, but when we revalued this 200,000. So it means there was a decrease. This is the initial value, this is the new value. So there was a decrease, and a decrease in the value of an asset. You have to, of course, to recognize the credit entry. You see, it comes automatic when you are balancing off the account. So this is 250,000. This is 250,000. So the decrease will appear here, the decrease in revaluation, because it is the balance remaining. So decrease in revaluation, which is 50,000. So this is a credit. Of course, when you are taking it to the revaluation account, it must be on the debit. So since it is a credit, I bring it to the debit side, and that is motor vehicle, which is 50,000. Then I look out for another asset which was valued. When after provision for budgets, you go to inventory was valued as this. So inventory was also valued, inventory. So I have to open up an inventory account. So inventory is an asset. Its opening balance must be on the debit, which they gave us as 500,000. Then the revalued figure was as my closing balance as 450,000. So 450,000. So it means if I balance off, obviously you see that since the initial value was 500, now the new balance is 450. There was a decrease. So I'm supposed to use this side to balance 500,000. This is 500,000. So now the balance, the remaining balance must appear here, which is the decrease in revaluation. Of course, decrease in an asset must be on the credit. Decrease in revaluation, which is, let me write the figure here, 50,000. I mean, is it 50,000? Yeah, 50,000. So it means since it is on the credit, when I bring it this side, it must be on the debit. So I recognize that this is inventory. Inventory worth 50,000. You debit and credit using the increase. So we have passed the entries. Now we are going to balance off this account and we see whether there is a profit on revaluation or a loss on revaluation, because you have to, depending on whether it is a profit or loss, you have to share it among the partners. So we said that after of course we have passed the document of revaluation. Now we have to balance off the revaluation account to ascertain whether there is a profit or loss on revaluation. Obviously, I was saying that this is, when you balance, this side is greater than this one. This is 100,000 on the local thing. This is 100,000. Even this one is 100,000. Are you seeing that? So you're seeing that there is a balance this side, which is of 30,000. The balance. Now you check. This is a balance which is on the credit side of the revaluation. So when you are taking it to the capital account, it is on the credit. It means when it is going to the capital account, it will be on the debit side, and the debit on the capital account of partners implies that they must be sharing the loss. So this figure, I give it a name, loss on revaluation. Loss on revaluation. Because it can't be on the credit this side and it goes to the capital account on the credit still. And so it implying that since it is on the credit, when it goes the other side to the capital account, it must be on the debit side. So, but this loss on revaluation, it is 30,000, but we have to share that loss in the profit and loss sharing ratios, all the profit sharing ratios which they gave us in the question. For partners, Amoti, it was for Amoti, this is Baluku, and this is Amoti, Baluku, and Chaos. Amoti, Baluku, and Chaos. So it means I have to show here how they are sharing this figure, loss on revaluation, how the partners are sharing that loss on revaluation. In other words, for Amoti, it will be 3 out of the total ratio, which is 6 times 3 out of 6 times 30,000. You'll be getting 15,000. Then it means amount is going to share 15,000 of that. Then you can go to the mirror here and maybe make appropriate ratios, share that ratio appropriately. So we are saying the profit sharing ratio are 3 to 1. You share that loss on revaluation using all the profit sharing ratios. These are the ratios. So this is, we say this is amount, this is Baluku, and this is Charles. So amount is supposed to be receiving 3 out of the total ratio times what? Times this figure which you are supposed to share, that loss, 30,000. So if you compute, you're going to be getting 15,000. Then Baluku is supposed to be getting 2 out of the total ratio times the figure. So you're going to be getting 10,000. Then when you go to C, C is supposed to contribute to that loss 1 out of the total ratio times 30,000, because it is our loss. You'll be getting this is 5,000, I think. Yeah, it is 5,000. So it means instead of writing this entire figure, you can put the ratios in which you are sharing profits. You can put that the balancing figure for amount, we will contribute, we have seen 15,000 on that figure. Then Baluku will contribute 10,000 on that loss. Then Chaos will contribute 5,000 on that loss. So you're saying that the sum of this must be the other figure, 30,000. So in an exam, maybe you have to mention this, that you tell us the amount which each partner is supposed to contribute to the loss. So it means that when you draw up the capital account, you have to reduce our capital account. You have, in other words, to debit the capital account in relation to share of this loss on revaluation. So it means when you're opening up the capital account, you shouldn't forget this loss on revaluation. So according to our question, we have finished drawing, of course, the revaluation account, and we have ascertained the figures we need, the loss on revaluation. Then part B was the question for the capital account, which I have drawn here. When you're doing the capital account, you must first of all include in all those partners. So you have to read the question to completion and see the partners, whether the partners leaving or is coming into the business. You have to include them in the T account for partnership, the partners capital account. Then they requested us to prepare the goodwill account, which I have also prepared here, and also any other ledger account which is relevant. We saw that the bank may be relevant in the case where partner is coming into the business. because our bank is going to increase since the partner is going to give us money, contribute capital. So starting from the partner's capital account, I can start with opening balance if they are there. So when you check the question, you give us opening balance. So I say balance brought down. For amount, his opening balance was, when you check the balance sheet, amount is 600,000. So I recognize 600,000. This is 500,000 for Baluku. And for Charles, it is 300,000. Then, after posting those opening balance, then I can value my goodwill, because I know that one of the contents of the partners capital account is goodwill, how they can share goodwill. So I recognize that they said, if you check the information, they say that the new business of A, B, and D respectively decide to eliminate goodwill from the books of account. So only that statement, eliminate goodwill from the books of account, is enough to tell you that they're employing the second method of treating goodwill, the memorandum revaluation method, whereby we recognize goodwill and remove it from the books of account. So they don't need to tell that the business is employing the memorandum revaluation method. As long as they've said that goodwill was recognized and maybe eliminated from the books of account, they are talking about the memorandum. So other statements may say maybe the partners decided that they maintain goodwill in their books of accounts, so it means they'll be employing the first method, which is revaluation method. But in this case, we are going to employ the memorandum. In other words, we debit goodwill, because we have seen this already, debit goodwill, goodwill account, credit partners capital account, partners capital, using the old profit sharing ratios. So I'm going to pass that into right away. And we know that in the question they told us old profit sharing ratios are 3 to 2 to 1. So the old ratios, let me write them here, are 3 to 2 to 1, old profit sharing ratios. So and my value of goodwill, let me check. Goodwill was valued at 150,000. So my goodwill is 150,000. So I'm supposed to be sharing this goodwill in these ratios and then passing the entry on the goodwill account and the partner's capital account. So this is, of course, Amoti, Baluku, and Charles. The old profit sharing ratio, so it is the old partners to share that goodwill. So Amoti will be getting 3 out of this is 5 times the 150,000. Then you'll be getting, I think, 90,000. Oh, now the total ratio, I think I had made a mistake here. It is 3 plus 2 plus 1, and that is 6. So this must change. This must be 6. 3 out of 6 times 150. So our answer has to be 75,000, not 90. So this is 75,000. If you check, so it means amount, we are supposed to be debiting amount with the 75,000. Then for Baluku, let me see. So it is 2 out of now 6 times the 1, times the 150,000. Here I'll be getting 50,000. Then for Charles, I want to get the goodwill for Charles. Let me record it up here. Charles. This is Charles. So for him, he's going to be getting his ratio is 1 out of the total, which is 6 times the 150,000. Now he's going to be getting this is 25,000. So now I've now shared my goodwill using the old profit sharing ratios, and now that I'm supposed to recognize goodwill initially. So debit goodwill using partners Amoti, Baruku, and Charles, which is Amoti is getting is so 75,000. Then Baruku is supposed to be getting 50,000. I recognize that there. Then another partner, Charles, is supposed to be getting 25,000, which is recognized there. So we have passed the debit entry. Now we complete the double entry by passing the credit on the partner's capital account, share of goodwill. So amount it was 75,000. So of course goodwill they are sharing, so their capital accounts are increasing. That's why I'm crediting them. Then for Charles, for Baruch it was 50,000, and for Charles it is 25,000. Means I can rub off this to obtain this space again. Now they say that they are eliminating goodwill from the books of accounts, meaning that you have to recognize goodwill and then write it off. In other words, you pass the opposite, you reverse the entry. You're supposed to now be debiting the capital account of partners, then you credit goodwill. But in this case, when you're writing off, we said use the new profit sharing ratios, new ratios. So it means I must look up in the question, what are my new ratios? They said The new ratios are so we have recognized our goodwill by debiting goodwill account and we have created the partner's capital account. Now, since they said we eliminate it, we are using another method. So we have to write off goodwill, but we use the new ratios. Our new ratios are 3 to 1 to 1, meaning that when I'm passing the entry, I must first of all, I'm going to be passing this entry on the capital accounts of only the new partners. And when in the question they said that one partner is leaving, Charles is leaving, and the new partner is it D? D is joining on the same date. So the new partners are A, B, and D because Charles left, and we are passing it using the new ratio. So Charles can't be part of that ratio. So it means that the 3 to 1 to 1 relates to A, B, and D. So it means that to know the ratios that amount is supposed to contribute is going to be 3 out of the total, which is 5, times the goodwill value is 150,000. So this is 90,000. Then I go to what Baruch is going to get. So this is amount. Now I can go to Baruch. Baruch is going to be getting 1 out of 5 times the total, the 150. So this is 30,000. Then you also go to this new partner is called just D. So D, let me first get the name of this partner. Is D, and D is supposed to be getting still 1 out of the total ratio 5 times 150,000, which also gives us 30,000. So now I'm supposed to be passing the debit entry on the capital account and the credit on the goodwill. Now when I'm writing off, I'm going to pass the entry. I credit goodwill using the new profit sharing ratios. So partner is supposed to be contributing 90,000. So I record that 90,000. Partner B is supposed to be contributing 30,000 of the goodwill, as in sharing 30,000 of the goodwill. Then partner D is supposed to be getting 30,000 on that goodwill. So now that is on writing off. I've passed the credit, but we are saying I've passed the credit on the goodwill account. Now I must pass the debit on the capital account. This is the capital account. I must recognize that some goodwill was written off because we are using Morana method. So goodwill written off as the detail. Goodwill written off. For A, it was the credit is here, the debit must be here. So it is 90,000 in place of A. Then in the place of B, it is 30,000. Place of D, it is 30,000 still. This one doesn't have a figure there because it's left, it's not a new partner. Then of course, after passing the writing off the goodwill, I remember that in the beginning we had some revaluation account whereby we shared the loss on revaluation. We are supposed to share the loss on revaluation among the old partners because these were the old profit. We shared this one using the old profit sharing ratios. So you take note that before C left, he shared also the loss. So that's why it's included in these partners. So now sharing the loss, this is a credit. Of course, when it comes to the capital account, it can't go on the credit, it must be on the debit entry. So we share that loss on revaluation. Share. Or let me put the detail loss on revaluation. Loss on revaluation. No, maybe use another matter here. Loss on revaluation. Loss on revaluation. Of course, these are the figures. For A, he shared 15,000 of the loss. Then B shared 10,000. Then C shared 5,000, I think. Yeah. Then we recognize that. So since the question was asking us for the goodwill account, which we have prepared already, and you are seeing they said that we recognize goodwill and we eliminate it from the books of accounts. So it means when you balance off this goodwill account, you won't remain with any balance. If you add this is I think 150, and if you balance this side 9 plus 9 plus 9, you'll be getting 150 still. So you're seeing that you have no balance. It means you show now the goodwill account will appear. So it means at this point in time I can rub off the goodwill account, obtain space, but that's how it appears it's supposed to appear. So I can rub off this goodwill account. So also the revaluation account, remember the only essential thing we are looking for in the revaluation where there is a profit or loss, and of course we saw that it was a loss and we got these figures because it is those figures that we take to the capital account. So it means at this point in time that's how the revaluation account is supposed to look like. So I can also remove it from the whiteboard so that I can get some space, but that's basically how it looks like. So remember in our information they told us, remember that some partner came into the business. So remember that when a partner comes into the business and contributes capital, we pass the double entry that is going to give us money because it's going to come to the business. We debit our bank account, and then we credit his capital account. We credit the capital because it's going to contribute capital. So his capital is going to increase. Capital increases by credit. So it means we check out. They told us that on retirement of Charles, they said when we checked the information, they told us that Charles retired, but on the same date, D was admitted to contribute 350. So when D was admitted, he contributed capital worth 350 million. Is it? I mean 350,000. 350,000. So when you contribute capital, I'm supposed to recognize that our bank account is gaining capital worth this, and our capital account, his capital account is gaining 350 because his capital is now increasing. So I'm supposed to be recognizing that I must have a bank account somewhere. I must have a bank account somewhere, whereby if you check the trial balance, I think we had some opening balance for bank, 200,000. If you check the balance sheet, we have 200,000 as the opening balance for bank. Balance brought down 200,000. But then this guy came into the business and gave us more money, so I have to debit my bank account with the capital of that guy, capital of D, which is 350,000. So I've passed the debit. Now I have to pass the credit on the partner's capital account. So this partner is the one who contributed the 350. I recognize it there, and it went to our bank account here. So I finished. But then you take note that they said Charles retired. So when a partner retires, you have to check, does he have a debit balance or a credit balance to ascertain? Because if he has a debit balance, it means that the business is demanding that partner money, and that partner is supposed to give the business. He has to pay the business. So our bank account, if the partner has a debit balance, our bank account has to increase. But in situations whereby the partner has a credit balance, it means that the partner is demanding the business money or the partnership business money. So it is the business going to pay that partner money. It means that our bank account must reduce. We have to have a credit on the partner's account. So you check. So I can first of all balance off this partner who is leaving his account. This side I'm having, if I try to balance off this partner who is leaving, this side I'm having 325,000. So we are saying since Charles is leaving, we have to ascertain whether he has a debit balance or a credit balance. If he has a credit balance, it means that Charles is demanding the business money or the partnership business money. We are supposed to pay him money. In other words, the bank must be reducing. And the credit balance means that when he balance, of course, I'm going to explain that scenario here in this example. So we first try to balance off the Chelsea's account because he's leaving. I have to ascertain we have to ascertain whether we have to give him money or not. So I check. This side, of course, is bigger than this side when I'm balancing. So I say 325 this side. Even this side 325. But take note that it means now if I'm trying to ascertain the balance, this minus this, I'll be getting 320 as the figure. This balance. I'll be getting 320 as this balance. 320. 320 as this balance. So it means, of course, this one is a credit balance. People may say that it's on the debit side, but remember, this is just a closing balance. We are going to bring it forward. If you bring it down, it will achieve its normal of the credit side. So you don't look at it in terms of is it on the debit side. You have to understand, is it a credit balance or not? Because we are saying it is here, somebody may say it's a debit balance. No, this figure is just a carry down. So if you bring it this side, you will achieve its normal of balance, which is a credit side. That's why you are calling this one a credit balance. So it means that since he's having a credit balance, he's the one demanding the business money. So it means Charles, the business has to give Charles money worth 320,000. But they said that in the question you are seeing, they told us that what was paid to this guy, Charles is paid 150 and the balance remains as a loan. So out of this money, 320, these guys just gave out of this money, they just paid what was paid. In other words, if you check what was paid, out of the 320, what was paid is 150,000. It means it was the bank. The bank must have lost money somewhere. That's why the detail has to be bank. So it means you go to your bank account and show that our bank reduced because you gave a partner Charles some money. which is 150. But remember, Chelsea was not demanding us only 150, it was 320. So it means the balance, 320 minus 150 is the 170. And that balance is what they are calling a loan. The balance remained the business as a loan. He gave a loan to the business, 170,000. So it is our loan, what I take as my loan. It means that, so I think it is clear, that concept is clear. It is 320 as his balance, but on that 320, they only paid us this, they only paid Chelsea this amount of money. So it means when they pay this one, you have to indicate a reduction in the bank account because you credit bank. Now the remainder is the 170, which is the loan in the business. It means when you are recognizing, so it means Chelsea is giving the business a loan. When you are recognizing when you are preparing your statement of financial position, you must recognize this loan in your current liabilities. So I think that concept is clear. Then you can obviously balance off other accounts and see the closing balances for other partners. So now, since we have ascertained Chelsea, we have finished working on Chelsea. Now we can work on the closing balance for all the other partners. So this is D is 350. Of course, it is bigger than this side. That's why I'm using it to balance. So I can now get my closing balance as they carried down now. The detail carried down. You know, let me write it in red so that I don't confuse. Detail, I'll carry it down here. This loan only relates to Chelsea. So detail. Let me put the loan here, the loan amount. Loan. Then I can put my balance carried down here with the capital accounts. For this one is 320. If you subtract 320, then I can now balance off these others. This one is 550. This one is 550. Use it here. 550. When I subtract from this, I get 510 as my balance. Let me use red. 510. Then this one is 675. This is 675. When I balance off with that, I'm going to be getting 5. Anyways, this minus 90 plus this, be getting 570. So these are the closing balances we are going to take to the balance sheet in relation to the capital account. So the remaining partners, that is A, B, and B, because Charles left. So I think I can also balance off the bank account here right away. Bank account. Of course, this side is greater 0.00055. Yeah, this is 550. No, this is 55. 550,000. So now this is our balance carried down as a subtraction. This is 400,000, I think. 400,000. So now it means now you can prepare your balance sheet, but you take note that in our balance sheet we are going to put these closing balances, this and this in relation to capital, because it must have an equity component plus capital. Then you don't forget that in your balance sheet you have to still put this bank loan. This loan has to be under your current liabilities. Then the closing balance for bank is there. Then for the other assets that were revalued, you know, in the balance sheet we take their closing balances. So you shall be taking their closing balances, or the new balances of the revalued figures, not the increase but the new balances. In other words, the carry downs we were preparing in those individual set accounts. What we take there, the closing balance, they act as our closing balances. So the new revalued figures will act as closing balances in the balance sheet for the individual assets that were revalued, and then other assets we shall be taking the figures that were given to us. So this has marked the end of our video in relation to goodwill, then treating revaluation and the capital accounts. Then in our next video, we are going to be looking at dissolution, and specifically we shall look at that situation whereby maybe the business is being dissolved and we are having an insolvent partner. How we are supposed to apply the Ghana versus Mali rule to account for an insolvent partner in our books of accounts. And that will be our part 3 of partnership accounts. So thank you for watching, and you can keep subscribing to our videos and referring other people to our channel so that we can get more subscribers and we continue sharing the knowledge.